Okay, let's look at the features and recording of preferred stock. These are some features you might see in preferred stock. Preferred stock could be convertible. What that means is that shares can be exchanged for common stock. Preferred stock could be redeemable. This means that shares can be returned to the corporation at a fixed price. They could be cumulative. Shares could receive priority for future dividends if dividends are not paid in a given year. Let's look at some comparisons of financing alternatives. We've got common stock, preferred stock, and bonds. In terms of voter rights, common stock has voting rights. Bonds do not, and preferred stock usually does not. In terms of the risk to investor, common stock is the highest, bonds are the lowest, and preferred stock is in the middle. For the expected return to the investor, common stock is the highest, bonds are the lowest, and preferred stock is again in the middle. For preference for dividends and interest, bonds are the highest, common stock is the lowest, and preferred stock is in the middle. In terms of preference and distribution of assets, bonds are the highest, common stock is the lowest, and preferred stock is again in the middle. For the tax deductibility of payments, bonds can be deducted, common stock cannot, and preferred stock usually cannot. Let's look at accounting for preferred stock issuance. Assume Canadian Falcon issues 1,000 shares of $30 par value preferred stock at $40 per share. For the cash, you're going to debit cash for the amount of cash you received, so 1,000 shares at $40 apiece is $40,000. For preferred stock, we're going to record that at par value. 1,000 shares at $30 par value gives you a credit of $30,000. The difference will go to additional paid-in capital. So $40,000 minus $30,000 is $10,000. This is what it looks like when you issue preferred stock above par. Here's an example of a stockholders' equity section of the balance sheet. In the past, when we've looked at the stockholders' equity section, it's mostly just been common stock retained earnings to make total stockholders' equity. But now we're going to get a little more detailed. So in this stockholders' equity section, we've got preferred stock first. This shows that they are $30 par value. They have 100,000 shares authorized and 1,000 shares that are issued and outstanding. So $30 at 1,000 shares is the $30,000. For common stock, they have a penny par value and 1 million shares authorized. The number of shares issued and outstanding is 1,000 at a value of $10. In additional paid-in capital, they have $39,990 for a total paid-in capital of $70,000. The retained earnings is $30,000, so $70,000 plus $30,000 is the total stockholders' equity of $100,000. Let's look at allocating dividends between preferred and common stock. If preferred stock is cumulative, preferred dividends might happen for arrears for 2019 and 2020. This could be $4,800. And preferred dividends for 2021 would be $2,400, giving the remaining dividends to common stockholders for $2,800. This is all part of the total dividends to be paid in 2021 of $10,000. Now below, if we look at preferred stock, if it's non-cumulative, if the company didn't pay out dividends in 2019 and 2020, they don't get any dividends in arrears. So the preferred dividends for 2021 will still be $2,400, and the remaining dividends to common stockholders will be $7,600 for total dividends paid in 2021 of $10,000. Preferred stock has preference over common stock in receiving dividends and the distribution of assets in the event that the corporation is dissolved. We record the issuance of preferred stock similar to the way we did for the issuance of common stock. Some preferred stock is cumulative, meaning any dividends not declared in a given year accumulate to be paid in a later year. Let's look at a concept check. Which of the following is a primary advantage of owning preferred stock? Preferential voting rights in most cases, tax deductibility of payments, preference over common stockholders in the distribution of assets in the event of dissolution, or a higher risk to investors than owning common stock. If you chose C, you are correct. Preferred stock has two major advantages. The first is first rights to specified amount of dividends, and the second is preference over common stockholders in the event that a corporation is dissolved. Most preferred stock has no voting rights, and usually dividends are not tax deductible. Due to the advantages of preferred stock, the risk to the investor is usually less than with common stock.